And just like that, AI mania that encapsulated most of 2023 is back. Google and Apple are in talks about Gemini AI integration into the iPhone. Tesla's FSD V12 is game-changing, and Nvidia's Developer Conference is underway. And it seems that the stars aligned today for what was a blockbuster mega cap rally. But can this strength continue? Today, we're going to discuss that and my thoughts on the S&P 500. I'll give you the roadmap on what I believe will happen in the next 2.5 weeks and where I think the market will go. We're also going to be talking about sentiment. The weekend poll just wrapped up, and we're also going to be looking at the results and stats that come post-OpEx. Should we sell the strength or hold the line today? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algo. Let's get into it. Quite the green day in the major indices led by mega caps, but not all mega caps. Amazon didn't participate really, and Nvidia, Microsoft, and Apple were not quite at the 1% mark like stuff like Tesla, Google, and Meta. Overall though, a pretty green day, especially right here, software. And you think semiconductors would do better after Nvidia's Developer Conference, but no. There was a very strong sector though, right here in financial services and diversified banks. Really green across the board. MasterCard, American Express, PayPal, really green for whatever reason. And then it was mixed across the board. There were winners, there were losers. Such goes the market. But having a look at the best performing sectors, look at the only two sectors to beat the SPY was IGV, XLC, so software and communication services. They only beat the SPY. Everything else underperformed the SPY, with technology, semiconductors eking out slight gains. Same here with financials. With the worst performing sectors, regional banks and real estate. And I think a lot of the pricing into these assets right here has to do with the dot plot. I think, people may be just getting a bit risk off in rate sensitive names. Now, today's market rally was led by the mega caps, and it was sort of like an amalgamation of a bunch of good news coming together, and that just lifted AI enthusiasm and euphoria. Now, Tesla's full self-driving, its version 12, I believe, came out, and there were very good reviews on just how great it was. Plus the fact that price hikes are coming to the Northern American segment, I think $1,000, which the market really likes, because the big story with Tesla is margins, bottom line, price cuts eating into free cash flow. Google rallied on AI news. Apple is integrating their Gemini AI into their phone, or they're in talks, something like that. So as a result, Apple and Google rallied, but particularly Google. This is really big for Gemini for the most part. As a result, because of this AI enthusiasm, Nvidia rallied, but they also had their developer conference as well as a release of their new Blackwell GPU. And this sent the mega caps rallying, and as a result, the indices are higher for the day. Now looking at the major indices, S&P 500 up 0.63, Nasdaq 0.9%. You can see it, the RSP, mid caps, small caps, IWM were all down anywhere from 0.1 to 0.57% for the day. Yields actually did tick up ever so slightly. This is after hours trade here, and then Bitcoin was down 1.46% in after hours. They did put in a gain on the day though. Very interesting trade nonetheless. Now Wall Street's officially involved in this, and I put on my Twitter that we're probably going to see some form of a carry trade here in Bitcoin, where they're going to long the spot, short the ETFs. The ETFs are going to be the short, and we're going to see what that looks like, because just as people FOMO'd into Bitcoin ETFs, they can FOMO out as well. It works both ways, especially with a new speculative asset. We don't have much data on Bitcoin. 10 years worth of data is sort of like the baseline you need to find statistical significance in anything, and we only have like 2 months worth of ETF data. But enough about Bitcoin. Let's hop on to the S&P 500. Looking at the weekly chart, you can see right here that we actually gapped up for the week on Monday yesterday. Now hopping on the daily chart, firstly, things to consider, guys. When we actually look at, the balance zone we're forming up here, it's virtually nothing compared to the actual blockbuster rally we've had since 2023, right here, and since October. Absolutely insane rally when you look at it. Now let's actually zoom in, to what we did on the day. Very interesting trade. So firstly, we're definitely forming some form of like a correction in time. The market has come up a lot, and this is really the first signs we're starting to see of some form of a correction where the market is sort of just digesting everything, and that's a really good thing. You actually want to see something like this. Now on the day, very positive day for the S&P 500. We actually did gap up, But let's actually hop on the 5-minute chart very quickly, just to see price action on a more nuanced level. Now, the majority of the move was actually predicated on that gap. Then right here at the top, the 51.80 level, sellers found value and then sold us all the way down, making lower highs, lower lows relative to the gap open where the candle is closed. And then we actually closed below that. So I guess you could say intraday a win to the bears, but that gap up does show bullish sentiment, as you can see right there. Now, back on the daily chart, couple things to note. In the weekend video, we said a very key level is this level right here, the 50.90 level, because it was last week's low. And what really needed to happen was the bears needed to take this early in the week and push us lower and possibly go and take this gap right here, this huge gap we have, very close to the 49.81 level. At the very minimum, they needed to close this week in here. Now, it's very possible they can still do that. It's only Monday, but a couple of things. We had this massive gap up. That's a very positive day for the S&P 500, led by mega caps, the market leaders in the last 18 months, right? And the work is cut out for the bears, right? Essentially, what they need to do is push to this 50.90 level and then take us lower. That's really what they want to do. This 50.90 level is sort of like where this balance zone is kind of supported. And at the top, this resistance is sort of like the 51.80, 51.90 level. And bulls have the clear advantage because bulls can actually just wait for a pullback to the 50.90 area and then buy the dip, and then we can go attack the 5200 area, which is the call gamma strike right here. Imagine if we take like 3 days to pull back to this level, right? The call gamma strike moves up to 5300. There's less of a hedging effect right here at the top. I do know we're in the window of weakness and it's not as strong, but you know, those effects are still there ever so slightly. So like we take 3 days to pull back to this level right here, find some support, move up, call gamma strike moves up to 5300, then we just go ahead and break these all-time highs. That wouldn't be unheard of. This was a definite win for the bears considering where we are. However, there's a lot of macro events, especially with the dot plot this week, interest rate decisions, and there's also a bunch of like real estate housing data and PMI data. So a lot that can take the bulls off course, especially at all-time highs. Data needs to come in line or better. We get a whiff of bad data, hot inflation data, and yeah, we're going to take a big dump. However, this is very constructive for the bulls. You can just wait for a pullback to right here, 50.90 to this 50.90 area, it'd still be constructively bullish, and you can buy it, or we could just rally and make new all-time highs. I'm just trying to provide you with the worst case scenario. The best case scenario is we're all already invested. We just keep rallying, making new highs, making new money, taking profits along the way. That could very much happen. But bears, if you want to really make something happen, you have to go ahead and take this 50.90 level. It's really what you want to go do. And you know, for the most part in this market, it's paid to be a bull. Other than that, guys, look at the 50.90 area. It's going to be a very key support zone, and bulls can take it easy this week. You can wait for the pullback, buy the dip, look for all-time highs. Bears, have some conviction, put some work in, and look below the 50.90 area. Now guys, I wanted to provide you with my S&P 500 outlook, and it essentially just mirrors the election year path. Now, trend is more important than level, so don't necessarily look at like the actual percentages. Look at the trend and what's about to happen. Now, normally we do end up a bit choppy and then we pull back, and I do think that we are going to get this pullback here at the end of March. Now, I say pullback, I actually mean correction. It could be a correction in either time or price. I think we're going to get both. I don't think it's going to be big. I think at most it's going to be like 5% peak to trough in the S&P 500, and then maybe it's going to be 2.5 weeks of just choppy sideways movement here, and that's how we're going to get our correction. All we're doing is looking for a dip buying opportunity that we normally get towards the end of March, start of April, for a blockbuster rally to ensue up until election day. Okay, so in the next 2.5 weeks, you want to buy the dip. If you're already invested in equities, I would say just hold and sit through the volatility. If we do get a pretty good dip, you know, 4-5%, buy that dip, but it's probably going to be a correction in time that's going to be very choppy and allow a peak to trough drawdown of about 4%, and it's going to be a very quick whiplash effect to the upside once we make that low. So you do want to be invested now, and you do just want to sit through the volatility, and you want to hold, and you definitely want to be in stocks in the next 2.5 weeks for, I do think, what is going to be a pretty strong rally into the end of the year, especially where the macro earnings and fundamental picture sits right now for the S&P 500 and companies as a whole. Looking at the week ahead, what can we actually expect from a data standpoint? So in the last trading 21 days, we actually closed off at a 2.33% 2% gain. It's actually a very, very good gain, especially for 1 month. Now, these are stats right here, March post-OpEx weekly performance when the trailing month is either negative or positive. We've just had a positive month, and normally we can actually see the average return negative 0.89%. 5 years we've won, 18 we've lost. So it does seem like, according to the stats, we should have a negative week because we've had a positive 21 trading days. And these stats for the other side are here too. When we've had a negative week leading into OpEx, we actually see fairly half and half returns. Average return 1%, but we have 9 up weeks, 8 down weeks. But this data is heavily skewed here by 2020 when March post-OpEx actually returned 10.26% in a single week. Kind of nuts. I actually remember that week as well. It was very, very crazy. Could not believe my eyes during that COVID week. It was such a crazy time. Now, the weekend poll is officially done, guys. This is what you guys believe the next 100 points in the S&P 500 to be. 64% of you said down, 36% of you said up, and I can guarantee you right now, this is going to be a contrarian indicator. I am going to go max long Monday. 64%. I don't think we've ever had such a bearish call. Because it's just a 50-50 stat, the numbers tend to be pretty close, pretty tight together, but seeing 64% down, that's a huge number to the bears. And maybe this has been a very good contrarian indicator. So if we actually finish positive for the week, to be expected. And if we finish positive for the week, I wouldn't actually be surprised. But let's switch gears and look at the latest NAM exposure number. And what this number right here tells us is how exposed fund managers are to US equities. And we officially hit above the 100 mark. This is only the 3rd time we've done so in the last year. And pretty much this means that fund managers are now leveraged long to US equities. Fund managers love US equities at the moment. And that's because they're at all-time highs, and there is no more signal more bullish than new all-time highs. Now, I have the data here, what normally happens when we get the NAM exposure above 100. And you can see 1 week later, median returns, average returns, pretty lackluster. So we can see some near-term weakness. But if we actually go 2 weeks, 2 months, 6 months, 1 year out, median returns look like 13 on average, 13.66% to 15.32%. And look at this hit rate, 89% of the time positive. 6 months later, very similar situation. And it seems that after about a month, after we get these really high readings, it's very linear returns. Look at this, 1.29%, 1.95, 3.47, 8%, 13%. So very linear returns we should expect over the next year, according to this data set. And it's no surprise that fund managers are leveraged long here on the NAM exposure because GDP figures are actually looking really good. Yeah, we were at 4% before, and GDP now is decelerating. But what you have to understand is that we're still sitting at about 2.1, 2.2%. It's pretty much at the blue chip consensus. So pretty much what all these big banks think we're going to do. And yeah, that's a very good GDP figure, all things considered, and just where we've come from in the last year when everybody was expecting a deep recession. We're actually growing the economy pretty effectively. Now, at the same time, LEIs, the leading economic index, has actually bottomed. This is a very good indicator of an oncoming recession. You can see it happened here, and here. We actually fell deep into contraction territory right here, but we haven't got a recession yet. And it does look like the LEIs have actually bottomed. Do take this indicator with a grain of salt. There's a huge emphasis on sentiment, as well as the yield curve and manufacturing sentiment data, and it doesn't give us the full picture. I actually think a far superior indicator is actually the coincident index, and the coincident index is actually very similar to this, but it's above the 0 line. It actually does look like this gray line right here. So do take this with a grain of salt, but you have to look at this and saying, hey, LEIs are bottoming out. And normally when they do bottom out like this, we get a steep recovery in the global economy, and that will be a tailwind for equities. Now with GDP data and LEIs in mind, 77% of fund managers expect the bull market to continue beyond 2024. The survey question was, when do you expect the US equity market will peak? After 2024, which means material upside. And the reason why fund managers are this bullish has to do with earnings. We got some Morgan Stanley consensus estimates right here, and look at what Morgan Stanley predicts 2025 consensus estimates to be. 266. The consensus is 277. And that is why fund managers are getting ever more so bullish, because earnings are coming in really good. We hit these consensus numbers in 2023. We're on track to hit the 2024 numbers, and that probably means we're going to go go and hit the 2025 numbers. And that is why fund managers and people as a whole are extremely bullish. At the same time, we're also seeing profit margins hold up materially well and actually set to expand in every single sector here in the S&P 500 in the US market for 2024. So this is plus minus, and now the green represents a plus, the red represents a decline, and you can actually see S&P 500 margins are set to increase in 2024. Same here with big tech, tech X, the rest of the S&P 500, and all of these sectors right here are expected to see margin expansion in 2024, and that's why stocks are rallying. We're seeing an increase in earnings, better macro picture, margins are expanding, and that is the reason why fund managers like stocks right now, especially large caps. But there is value to be had in small caps. Small caps remain historically cheap versus large caps on a relative forward PE basis. This is the Russell 2000 versus Russell 1000. This is the average right here, and you can see that small caps remain historically cheap, and that's because the earnings picture for small caps is not looking that good. But I do think that they are attractively priced and have priced in a lot of that earnings loss, and they should return to earnings growth here in the second quarter, third quarter of 2024. Now on the weekend, I showed you guys this chart right here. Equities are sitting at a record $56.1 billion worth of inflows, some of the highest numbers we've seen since year 2021, 2018, 2022. At the same time, we got the data for crypto, and we saw $3.4 billion worth of inflow to crypto funds. You could see that these ETFs are really allowing a lot of money to flow into crypto. This is some of the highest we've ever seen, and doubling the peak we saw here in 2021. So there's a lot of money flowing into crypto via these Bitcoin ETFs, via Bitcoin futures, Ethereum futures, etc. Now on the topic of total market volume, options volume surpassed that of shares during this month after a period of 2 years, largely driven by semiconductor related volumes. Notional options versus notional shares volumes of US single stocks since 2019. And once we cross this line right here, options volume is greater than share volume, and we've seen options volume deteriorate since the peak year in 2022, but we are officially now in a market where options volume, leveraged options volume, is bigger than single stock volume and can create a lot of volatility. And when we normally get above this line right here, we tend to be in a market that has these huge upside gamma squeezes. So the market gets even crazier from now. Don't be surprised. But let's actually talk about gamma. Looking at the gamma chart, very, very interesting developments right here. The biggest development I can see is this 5,000 strike being built out here in negative gamma, as well as the 5,200 positive gamma strike staying where it is. Now do take into consideration that this won't really affect the market much, simply because a lot of gamma has been rolled off the tape. The chart does look like it normally does, but you have to look at these numbers. Last week we saw a 3-year, a 2-year, a 1-year. Now we're seeing -1 on the upper end. At the same time, the gamma flip zone has actually moved up because of the amount of positive gamma that has come off the tape relative to the amount of negative gamma that has come off the tape. And we're now sitting at 51.40. So that's the line in the sand. Below here, we look to the 5,000 strike. Above, the 5,200 strike. Now I do expect the 5,000 strike right here to offer very, very good support, simply because we have a huge positive gamma strike right here. And I think this is just literally market makers telling each other, hey, this is where we bounce. So we get to 5,000. I think that's a good dip buying opportunity. We're going to see what this core gamma strike looks like towards the end of the week. If it still stays there, if it gets bigger, 5,000 is the line we buy heavy, because that's going to be a good dip buying opportunity. But as it stands right now, we want to play day by day. And the big thing we want to watch is how does this fill up during the week, and how does the negative gamma strikes fill up? We want to see which strikes are larger and how much positive gamma comes into the tape relative to negative gamma, and where the strikes reposition themselves. Does this keep moving up to 5,100? Does it stay at 5,000? And the big question, where does this strike revert to? Does it stay at 5,200 or does it move up? If it does move up, that's a big deal. So we really have to watch how this chart fills up with gamma over the next week. That's going to be the major thing, especially leading into the last week of March and into April as we look to OpEx. But as it stands right now, this chart is giving off more bearish tones than it is bullish tones. However, there isn't much gamma on the tape, relatively speaking, to what we normally see in the first few weeks leading up into OpEx. So do take it with a grain of salt. Now guys, let's actually look at some more charts. All this is right here is 52-week highs versus 52-week lows since the 1st of November. And if you just do the eye test, every single sector, even the S&P 500, IWM, utilities, materials, discretionary, technology, every single sector is making more 52-week highs than stocks are making 52-week lows, as you can see from this data. Now this right here is the advanced advanced decline line, something I love looking at, another breadth metric. And this is on the weekly chart of the S&P 500. And you can see that even though we did put in a lower high this past week, the advanced decline line actually moved up in a very big way. At the same time, we also saw the same thing happen here in the S&P 500 daily chart. Now, it doesn't look like it, but let me explain this to you guys. Right here, okay, we sort of made a high on this candle. Then we made a low right here on this red candle. Then we actually made a lower low in the S&P 500, but the advanced decline line actually ticked up. What does that mean? More stocks advanced on this candle than actually declined, and that's why we had an uptick, the advanced decline line. So we have more stocks advancing on a weekly basis, more stocks advancing on a daily basis, despite what the S&P 500 does. And this is great breadth metrics to see, and it pretty much tells us that a lot of the selling we're seeing right here has to do with the bigger names in the index, and we are starting to see that rotation happen under the hood. Now we're going to look at a couple of charts with regards to the credit markets. The credit markets are super important because they move the markets. They're such a huge part of the economy as a whole. Stocks don't move the credit markets. The credit markets move stocks and the economy as a whole. So we're going to look at stuff like credit spreads, yield curve, money supply, and we're going to use these as risk on, risk off indicators just to see where we are in the economy and how everything is holding up. This is the yield between BAA corporate bonds and US Treasury bonds. So BAA corporate bonds are pretty much like one level above junk bonds. So it's pretty much like investment grade, your average bond, like your B-rated bond, and then you have like your BAA bond, and then you have like a junk bond. This is like one level above a junk bond, and you can see that spreads continue to decline and move further down. They continue to tighten from their highs here in 2020, and we're actually even below the levels we saw before the COVID situation right here, and spreads are very tight, signaling that it is risk on for now in credit markets as well as equity markets. Looking at AA corporate bonds versus US Treasuries, very similar situation. Spreads are tightening, still not as tight as they were here in 2021, 2022, but they are moving in the right direction, although a little bit of a base is forming here. However, we are still at historically tight levels, all things considered. Looking at the spread between mortgages and US Treasury bonds, so essentially this tells us, how much more the average American is paying on top of the US Treasury bond for their mortgage. And you can see that this number is actually declining. We had this massive ramp up as rates increased, but since the highs right here, late 2022, early 2023, we've actually come down, and mortgage rates hopefully should decline to below these levels, making the housing market more effective. And hopefully that helps residential real estate, and then that flows on to commercial. Now this is M2 yearly growth versus inflation. So you can see that after this massive uptick here in COVID, the money supply has come down significantly as inflation has come down. Now inflation hasn't budged in the last 3 months, and I think a lot of that has to do with M2 growth right here. When M2 grows, inflation increases. So we're going to really have to see what the Fed says this week about where the money supply is going, where they're going with inflation, as well as rate cuts. Now looking at the yield curve, this is the 10-year minus the 3-month spread, and we are still inverted and in a deep inversion. Look at 2020, that was a very small inversion. Look at 2008, a tiny inversion, and 01 as well. And as a result, we're in this deep inversion right here. And I think this actually has a lot to do with the Fed. They've created this inversion, where a lot of this was actually the market creating this inversion. There's two very different sides of the aisle, and the only way we're going to uninvert from this yield curve is if Fed cuts rates. So the FOMC is going to be absolutely keen to see what interest rate projections are, what the Fed thinks interest rates are going to do. And I think that even though the Fed are struggling with inflation right now, they really do need to cut rates to normalize interest rate policy. Otherwise, a deeply inverted yield curve for this many years is really going to affect the financial markets in a way that we don't really know how, because this is the deepest yield curve inversion, and it can have negative forward-looking consequences. Now looking at data in this week ahead, guys, the big one is obviously Wednesday, but on Tuesday we have housing starts, building permits, then we have everything to do with the Fed, FOMC, interest rate projections all year, as well as Jerome Powell speaking at this press conference. And then on Thursday, we got initial jobless claims and some PMIs, as well as global PMI data. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algo. Cheers.